Welcome to Conversations, a weekly audiocast featuring interviews with leading investment strategists and recognized financial professionals. Brought to you by the Market Technicians Association. Statements may reflect the opinions, estimates, and current projections of Aegon USA Investment Management LLC as of today and are subject to change. Such statements are intended for airing exclusively by the sponsor to invited participants on this call. The discussion includes no recommendation to buy, sell, or hold any specific security and should not be considered as constituting investment advice. Past performance is no guarantee of future results.
This is Conversations, the official MTA podcast series, and today's guest is Brad Beman. Brad Beman, CFA, CPA, joined Aegon USA Investment Management in 1988. Brad is the Chief Investment Officer and Director of Public High Yield. In his role as Chief Investment Officer, Brad oversees a broad variety of asset categories in the U.S. and Netherlands, including investment-grade credit, high yield, emerging markets, commercial mortgage-backed securities, residential mortgage-backed securities, distressed, and cash management. Brad is a lead portfolio manager for the public high-yield portfolios. Prior to his current role, Brad held various investment roles, including Director of Fixed Income, Director of Credit Research, and Public Fixed Income Research Analyst. Brad received his BA from the University of Northern Iowa and his MBA from the University of Iowa. Welcome to the program, Brad.
Hey, thanks a lot, Lance. I appreciate you carving out some time to talk to me today.
Absolutely. Well, let's start at the beginning. How did you get interested in the markets?
You know, I mean, my story is probably, maybe it's a little bit unique, but I would say from my prospect, I actually didn't grow up with a passion for the capital markets, for understanding following stocks. For me, it was a little bit more of a story where I graduated with an accounting degree, and the institution I worked for at Aegon was a rather small institution. And really, I decided after a year it was more of a dislike for accounting that led me to take a role in the investment side, which I thought sounded interesting, but I really didn't know how interesting it would be to me. So as I took that role after my first year in accounting, I really started to, what I'll say, develop that passion for the markets and wanting to understand them, and really just, you know, I'm a relatively competitive person, and I think one of the things the markets gives you is a scorecard every day on both the equity and the fixed income side. So you can see how you're doing and compare yourself to the rest of the world. So it's a very interesting business. It's a very humbling business. And it's different every day, and I think that's part of the attraction of being involved in the marketplace.
Mm-hmm. Now, have you always worked on the fixed income side of the financial markets?
You know, I have. My history really is all in fixed income. I started off working more in the private placement space, and then in 1990, the early 90s, I'll say 91 or 92, got involved with high yield as the organization was expanding and broadening into the asset class. So stayed in high yield, been in high yield the balance of my career on, and then have since broadened into other asset classes that have different respective metrics or drivers of those asset classes. Whereas high yield is predominantly credit, and I got to utilize my accounting skill sets and understanding financial statements. More recently, I've spent a lot more time looking at things like securitized related assets and spending more time on the macro related environment and rates and those related issues.
Now, when you think of technical analysis, you typically think of that applied to equities, but you're one of the resident experts of technical analysis at your firm. How did you become fluent in technical analysis if you've primarily worked in bonds?
You know, I think a couple things I would say there. First, if you understand the high yield marketplace, or if you understand the fixed income marketplace, as it relates to credit, what you understand is a lot of the companies that actually have credit outstanding also have equities outstanding. And I've always had the belief that the equity markets tend to be, at times, can be a little bit more of a leading indicator with what's going on, since they're the marginal dollar at the bottom of the capital structure. So I've always had a tendency to follow the equities associated with the companies that we're lending money to on the credit side. And I think the other thing is the mentor that I grew up in the business with had a long history of analyzing equity portfolios. So he kind of groomed me, and I kind of grew up with more of a technical sense or an understanding of the equity markets on both the fundamental and the technical side.
Okay. So how have you successfully used technicals at your firm and in an industry that's so dominated by fundamentals?
Yeah, well, there are a lot of technicals in the fixed income market. It's very unlike in a lot of respects the equity market as far as how it's traded at the dealer exchange versus an equity-related exchange. But I kind of think about the way I look at not only the fundamentals but the technicals, technical analysis from kind of some big picture related items and then some micro related items. If you look at the big picture related items, things as simple as VIX, utilizing as a fear gauge, has a pretty good correlation with spreads in the high yield marketplace. So that's an example of something that we've utilized as a risk management tool. For example, when VIX has gotten relatively low, spreads have been relatively tight, and we utilize that as an opportunity to de-risk the portfolio. Correspondingly, or the reverse of that, obviously, is when VIX is hit historical markers. There's a lot of fear in the marketplace. We've used that as an opportunity to add risk, and then we've applied that a further level down by helping us think about the types of sectors we should add risk in. And then on what I would say is I've always followed the equity charts on the bottom up, looked at things like relative strength of the individual names we would be looking at, the ones that do have equity positions, and I'll utilize that tool as well, not always to make the credit investment decision, but certainly to make sure I'm asking the right questions. And we'll do that on a sector level as well. For example, looking at commodity charts, are they breaking down? Are they getting into long-term sell modes? How is that going to affect our secular, our thematic positioning in those and our portfolios across the credit space?
Mm-hmm. So let me transition to your specific high yield portfolio that you've managed since mid to late 90s. Is that correct?
Yeah, I've been involved with the high yield product since the early 90s, and I took over the management of the portfolio in 1997.
Okay. And I'm looking at your track record, which is spectacular, and I'll pick out the high points. It looks like your 5-year performance is in the top 2 percentile, and your 7-year performance is in the 4th percentile. So you've managed to add risk or take risk, I guess, in the proper order with looking at the last market meltdown. You took risk off the table at the right time, and you added risk at the right time. But in the bond market, you have to do that well ahead of the actual events. And you, correct me if I'm wrong, but you can't change your mind after you've done it. If you sell a bond and you change your mind, that bond might not be available to buy back. So,
Yeah,
so tell me some of the tools that you're using to make those decisions. And specifically in 2008, when you decided to take risk off the table, and 2009 add risk, what kind of tools were you using to give you the confidence to do those things at a very uncertain time?
Yeah, certainly going into the kind of the 06, 07 period where we were de-risking the portfolio, I think the decision, the tools we're looking at are things like I commented earlier, at the VIX, at the general complacency, which we use as a gauge for complacency in the marketplace. And when there's complacency, to us, there are two things. You're not getting paid for risk, and usually the lower quality marketplace offers very little incremental value as everybody's stretching for yield, trying to keep up with the next quarter. And B, positioning tends to be very long in the riskiest sectors. And back to the liquidity comment that you made, yes, the fixed income markets are very illiquid. And our theory internally is you have to take advantage of what the market's giving you. So in periods like that, where the market or the bid in the marketplace is heavily skewed towards the lower quality, and there's very little risk premium there that you're getting paid for, and there's a lot of complacency, we try to take advantage of those or utilize those times to be very disciplined on the risk management side and reduce risk. The same, it's just the flip side on the opposite. When you get into late 08, early 09, essentially the fear gauge is off the charts. People are willing to sell names because they don't want to explain it to their board of directors at whatever price. In the high yield marketplace in particular, people are fearful about events like bankruptcy, which doesn't mean necessarily additional value destruction. In many cases, it means value enhancement. So, we look for those opportunities, assuming you're properly positioned going into it, to take advantage of that fear in the marketplace, that forced selling. One more thing I'd say is we kind of view positioning, we're probably tend to be a little bit early than most participants, because most of the supply in the marketplace or most of the bid tends to come when everybody's trending one way in the marketplace. So for example, where there's a lot of fear in 08 and 09, the reality is most of the forced selling occurs before you get to the bottom, before the fundamentals start to improve. So I always look at it as I may be buying, taking a little additional downside, but our internal view is picking bottoms is a fallacy anyway. Very few people actually tick the bottom, and when things are starting to improve on the upside, I don't want to be standing in line trying to build my position in an illiquid market with 300 other investors. So we try to be a little bit early in our positioning and in our themes in the portfolio.
How early is early? You have a $3 billion portfolio. If you have, when you were getting bullish in front of the bottom and you said you can't pick the bottom, how early do you have to be properly positioned for a bottom?
Well,
how long does it take you to build a position is what I'm asking.
Right. I think if you think about it, if you're buying when everybody else is selling, you can build a position relatively quickly. So I'm buying into the fear of the marketplace, what I'll call the weak emotional nature of the marketplace. And I think when you're doing that, you can build a position relatively quickly because you're buying the thing the market doesn't like, and you're selling them the thing that they love at that point in time. If you wait until things turn and you want to feel more sure about your call, the value proposition is probably less and your ability to accumulate is less. So when we're talking early, we're talking we could go 3 to 6 months, and part of the way we still protect the downside when we're going in early is we'll start positioning on for example, our trade in 08 and 09, we started buying what I'll call higher quality cyclicals. So we didn't run right into the bottom end of the market, but we tried to pick the better names that came under pressure that were offering a lot of value. So we stepped our way into the market, and once we felt more comfortable that we were hitting some sort of a bottom in the marketplace, we stepped into the bottom half of the trade, or stepped down into the deeper into the trade.
Okay. Well, as I said before, now you are Chief Investment Officer, but you're still managing the high yield portfolio. But you have many more asset classes under your care. As you look back in your career, what risks did you take to get to where you're at now?
Well, certainly I think the jump from an analyst to a portfolio manager is a big jump. And I think when that jump occurred for me, I think that was probably a little bit of a defining moment. So that occurred back in the 90s. And I think the other big risk for me personally, or the other really uncomfortable position I had, was really when I broadened my accountabilities outside a very niche sector in high yield into a broader range of asset classes, not all of which were credit related. Some of them were in the securitized space. So I had to take up a learning curve in a very short period of time, and there's different nuances in different sectors, different technical factors that tend to drive behavior. The one thing that it has in common in all of them, when there's fear, in an asset class or in a macro environment, it affects all the sectors. And I think that's what investors keep learning, is when there's a lot of fear out there, all the correlations go to one, or they go to a very high level. So there's very few safe havens. So you can still take advantage of that psychology in almost any market, whether it is high yield, investment grade, CMBS, RMBS. Those sort of emotional trading patterns still occur in all asset classes.
Sun still works.
Yep.
So if you could go back to 1988 and you had your career to do over again, what would you change?
Wow, that is a loaded question. I probably would have spent more time away from. I currently live in Cedar Rapids, and I think it's been a great opportunity for me to grow up and be able to get involved in a kind of a broad U.S. portfolio, more recently a broad global portfolio. But I think I probably would have spent a little bit more time in a bigger metropolitan area that had a broader landscape of financial opportunities. My career kind of grew with the company, whereas if I would have got involved in some other opportunities early on in my career, I think that would have been advantageous. And also with hindsight, although I dearly love fixed income, I think it's very interesting. I think it's an underestimated career. I think equities have been oversold, fixed income's been undersold as a marketplace, and the interest to invest in and the challenges, quite honestly. I think I probably would have tried to find some sort of avenue to spend a little bit more time in equity analysis. And if I had to go all the way back to my college days, I would actually tell you that if I had to go back and study one thing more, as I've learned in the markets over the years, it would be behavioral psychology. At the end of the day, the markets are really people, and people make decisions in the markets, and if you understand that, and you understand fear and greed, and you understand overextension and underinvestment, you can tend to make a lot of money in those sort of environments.
Last question. Where are we? Where do you think we are in the credit cycle?
Well, I think the market is, I think the challenge we've had in the marketplace coming out of 2008 is we've probably been in a continuation of this, I'll call it the secular deleveraging, or what we call the big chill. Here internally, I think the mistake that investors have made is differentiating between how the markets could perform in a slow growth environment. So to put it differently, I think too many people have taken a secular deleveraging as a read that the markets can't go up. And the irony is you have to factor in your beginning valuations, and I would remind listeners that, listen, in that whole environment in the last 4 years, stocks have doubled, right? Because the valuation was right. People probably underestimated the global policy response. Now we're doing a little bit of a replay of this in Europe. I still think we're pretty early on. Let's say the middle part, in baseball analogy, we're probably in the middle innings economically. You still have policymakers on the monetary policy side that are really been the counterbalance to some of the fiscal headwinds that we've had, some of the private sector deleveraging headwinds. So I think things will remain, on the economic side, I would say, probably continue to improve on the margin, particularly for the U.S. here in the coming years. On the market side, I think we're probably further along. The market's always ahead of the economy. And one of the barometers I'll be using or continuing to use is I look at the yield curve as a proxy. And usually when the yield curve flattens and look at the 2s, 10s on the yield curve, I think then you'll be getting at a point in time where you're probably reaching some sort of top with the front end anchored and policymakers continuing to be responsive. I continue to believe we've probably got at least another year or two of a situation where the economy is looking to kind of be in a slow growth pattern and then start to improve.
Mm-hmm. Okay. Brad, where can listeners find some of your research, read about your funds?
Yeah, sure. We have a variety of products here at Aegon USA Investment Management. So we have a short duration product that we have under the Transamerica label. We also have a high yield bond product and really a core plus or a flex related product. In addition, under that label, the Transamerica label, you can find a lot of our mutual fund related products. We also have what I'll call a tactical income fund that is really based on, it really capitalizes on this thought process about unemotional investing. And it balances its allocation based on metrics that are coming through in the macro environment and the market environment. Just kind of reading what's going on there and trying to participate in the market with the upside on the stock market when it's going up, and protect the investor on the downside when the market's going down by trying to outperform the gov credit portfolio on the bond side. So we've got a variety of products, some on the active side, some on the passive side. And I think the listener could go out to the Transamerica mutual fund website and find those products available to them.
Very good. Anything you'd like to add before we go?
No, I really probably can't think of anything right off the top of my head. Just would put in a plug for fixed income, since everybody always talks about equities, and say I think people underestimate the challenges and the complexity and really the excitement of fixed income. There's a lot more going on in the fixed income space than people understand, and it's really a great opportunity for people if they're interested in a career set period in the capital markets. It doesn't have to occur on the equity side.
Today's guest has been Brad Beman, and that concludes today's MTA podcast. From LexingtonCapitalLLC.com, I'm Lance McDonald, together with recording engineer Shane Skwarek at the MTA, reminding you that price is always right.